A lot of people have a general idea of their total net worth but don't necessarily know what their monthly cash flow is. And it's extremely important to understand both of these because it's possible to have a high net worth while having low monthly cash flow. For example, if you have investments in private equity like a startup company, that could bolster your net worth substantially. But in terms of generating cash flow, you won't see anything from that investment unless you have an exit from that startup. Another example of this could be the equity that you have in your home. If your mortgage is paid off, this is great for your total net worth and lowering retirement expenses, but it does nothing for your monthly cash flow. In an ideal scenario, you want to have multiple different retirement income streams providing you with consistent monthly cash flow. And it's also important to make sure that you consider inflation. Simply put, inflation is the shrinking of your money's value over time. In the past, this was largely an afterthought as people assumed that 2% inflation would be the norm. And while it has come down from the 7% rate we saw in 2021, inflation is still much higher than the normal range, being 3.3% for the 12 months ending in May. Let's say you calculate an annual retirement expense of $60,000 today. If we continue seeing that 3% inflation, that means in 10 years you would need to spend $80,600 per year to have the same purchasing power of the original $60,000. And in 20 years, that would be a little bit over $108,000. Now, I know these are some scary numbers, but the Federal Reserve is still actively fighting inflation through higher interest rates. Hopefully, we get back to the target 2% inflation rate, but you should plan ahead for elevated levels of inflation. And this could have an impact on your portfolio because some investments are a better hedge against inflation than others. For example, with rental properties, you have the ability to increase rents over time to keep up. In addition, Social Security benefits are adjusted annually based on the Consumer Price Index. Part of this monthly cash flow step is also figuring out whether or not you plan on working part-time during retirement. For example, if you planned on working 20 hours a week for something to do, that extra $1,200 a month or so could go a long way. You can write down your monthly retirement cash flow wherever you compiled your anticipated retirement expenses. And if your retirement expenses far exceed your monthly cash flow, you might need to either adjust your spending or wait until you have built up more assets to retire. And again, don't forget to consider how inflation will come into the equation.